In 2001, Enron reported earnings per share of around $1.12. Free cash flow was deeply negative. A year later, the company was bankrupt, and employees lost billions in retirement savings. That gap between reported earnings and actual cash generation wasn't an accident. It was the warning sign hiding in plain sight that most investors completely ignored. And here's the thing. That same dynamic is playing out across dozens of publicly traded companies right now, today, in portfolios that millions of retail investors hold without even realizing it. Earnings can be manipulated. Free cash flow is much harder to fake. That's not an opinion. That's accounting reality. And once you understand why, you'll never look at an earnings report the same way again. So let's start with what changed and when, because the obsession with EPS as the primary valuation metric really took hold in the 1990s. Wall Street discovered that analyst consensus estimates could move stock prices, that companies could manage expectations, and that beating earnings by a penny was enough to send a stock up 3 to 5% in a single session. That feedback loop created an entire ecosystem built around gaming a single number. Companies began leaning heavily on accrual-based accounting techniques, recognizing revenue early, deferring expenses, stretching depreciation schedules, capitalizing costs that probably should have been expensed. None of this is necessarily illegal. It's all technically within the rules. But it means that EPS, the number CNBC flashes across the screen every quarter, can diverge wildly from the actual cash a business is generating. Free cash flow doesn't have that problem. Free cash flow is simply operating cash flow minus capital expenditures. It tells you how much actual cash the business produced after it paid to maintain and grow its operations. You can't defer a cash payment. You can't recognize cash you haven't received. The cash either showed up in the bank account or it didn't. That's why Warren Buffett has called free cash flow, or what he terms owner earnings, the most important number in evaluating a business. He wrote about this in the 1986 Berkshire Hathaway shareholder letter, and as of this recording, nothing has changed about the underlying logic. Now let's get into the data, because the difference between EPS and free cash flow becomes staggering when you look at specific companies. Take a stock like Amazon. For years, Amazon reported minimal or even negative net income, and analysts who focused only on EPS either avoided the stock or called it overvalued. Meanwhile, the free cash flow story was completely different. By 2020, Amazon was generating roughly $25 billion in free cash flow annually. By 2023, that number had expanded to over $32 billion. Investors who anchored to earnings per share missed one of the greatest wealth creation machines of the last 2 decades. Flip it around, and you get the cautionary tale. WeWork reported revenue growth and pointed to adjusted metrics that excluded inconvenient line items. Free cash flow was catastrophically negative, burning through cash at a rate that made the business model fundamentally unsustainable at scale. The IPO collapsed. SoftBank lost billions. Investors who looked past the narrative to the free cash flow statement saw this coming well in advance. Right now, as of this recording, there are several dynamics in the broader market that make this analysis more urgent than usual. The S&P 500 is trading at a forward price-to-earnings ratio of somewhere around 20 to 21 times, which is elevated relative to the historical average of roughly 16 times. At those multiples, any disappointment in actual cash generation relative to reported earnings becomes a significant valuation risk. When rates were near zero, investors were willing to pay for speculative earnings projections. With the federal funds rate still in restrictive territory, somewhere in the 4.25% to 4.5% range as of early 2025, the cost of capital has reset, and companies that were surviving on cheap debt and accounting-friendly earnings presentations are now under genuine pressure. Goldman Sachs published research showing that companies in the top quintile of free cash flow yield have historically outperformed the broader market by roughly 3 to 4 percentage points annually over rolling 10-year periods. That's not a small edge. Compounded over a decade, that difference can mean the gap between retiring comfortably and falling short. Let's talk about the bull case for focusing on free cash flow as your primary lens, because there are at least two concrete reasons this approach is more valuable today than it's ever been. First, AI and technology infrastructure spending are creating a massive divergence between capital expenditure intensity and reported earnings. Companies like Microsoft, Alphabet, and Meta are investing tens of billions in data centers and compute capacity. In the short run, this hammers free cash flow. But the companies that manage to convert that capex into durable, recurring cash generation over the next 3 to 5 years are the ones that compound the most value. Microsoft, for example, generated roughly $75 billion in free cash flow in fiscal year 2024. That's the kind of number that supports both aggressive reinvestment and shareholder returns simultaneously. Analysts at Morgan Stanley have price targets on Microsoft in the $500 to $520 range, partially predicated on continued free cash flow expansion driven by Azure and AI monetization. Second, companies with strong free cash flow have real optionality. They can buy back stock, pay dividends, make acquisitions, or simply hold cash as a buffer. Apple has returned well over $600 billion to shareholders through buybacks and dividends over the past decade, funded almost entirely by free cash flow that averaged somewhere between $80 and $100 billion annually in recent years. That's not earnings management. That's real money flowing out of the business to owners. Now the bear case, because this isn't a one-sided argument. The first real risk is that free cash flow can also be temporarily inflated in ways that mask underlying weakness. Companies under pressure to show strong cash generation sometimes cut necessary capital expenditure, deferring maintenance, delaying R&D investment, squeezing working capital in ways that aren't sustainable. A retailer that stops refurbishing stores might show strong free cash flow for 2 or 3 years before the deterioration in the customer experience starts hitting the top line. You have to look at the trend in capex relative to the needs of the business, not just the free cash flow number in isolation. The second bear case risk is that in a slowing macro environment, even fundamentally strong free cash flow generators face top-line pressure. If revenue growth decelerates because the consumer is pulling back, and consumer credit card delinquency rates have been rising, with the New York Fed reporting that serious delinquencies, meaning 90-plus days past due, on credit cards hit roughly 10% in late 2024, then operating cash flow shrinks regardless of how disciplined a company is on expenses and capital allocation. High-quality companies are not immune to recession risk. On the insider and institutional activity front, one thing worth watching is how sophisticated money tends to position in names with high free cash flow yields during periods of market uncertainty. As of recent 13F filings, firms like Parnassus Investments and Ariel Investments have been systematically overweighting companies with free cash flow yields above 5% relative to their market caps. That's not a coincidence. Free cash flow yield, calculated by dividing free cash flow per share by the stock price, is one of the cleanest signals of relative value in the market. A company trading at $25 per share with $2 of free cash flow per share is yielding 8% in real cash terms. That's a number you can compare directly to bond yields, to money market rates, to other asset classes. It gives you a grounded anchor for valuation that EPS simply can't provide. For what to watch going forward, keep your eyes on the next round of earnings season reports, specifically the cash flow statement, not just the headline EPS beat or miss. Look at the divergence between net income and operating cash flow. A persistent gap where net income consistently exceeds operating cash flow is a red flag that deserves further investigation. Watch the Fed's next rate decisions, because the discount rate you apply to future cash flows matters enormously for valuation. And watch insider buying activity in names with strong and improving free cash flow that combination, real cash generation plus insider conviction, has historically been one of the most reliable signals in equity research. Here's your practical takeaway. Pull up any stock you currently own or are considering. Go to the cash flow statement. Find operating cash flow. Subtract capital expenditures. Divide that number by the current market cap. If the yield is below 2% and the company isn't in a high-growth phase with a clear path to cash generation, you're probably paying for hope dressed up as earnings. If the yield is above 5% and the trend is improving, you're in territory that institutional investors find genuinely interesting. The market rewards cash. Everything else is a story. This is not financial advice. Do your own due diligence, speak to a licensed professional before making investment decisions, and always understand the specific risks of any individual position. But if you walk away from this video understanding one thing, let it be this: cash is fact, earnings is opinion, and the investors who consistently build wealth are the ones who know the difference. One quick note before you go. This video is for education only, not financial advice. Always do your own research before making money decisions. If this helped, subscribe to Money Clarity for clear investing breakdowns every week.